Okay, everybody, welcome back. Here's the news today. In Texas, more have voted early, this is from the New York Times headline, than the state's entire 2016 turnout. So let's start with a hand raise. How many have voted already? How many have voted already? Let's do participant hand raises here. Let me get over to it. So 20 out of, let me just give a few more, 20 seconds or so. How many have voted? We've got 42 attendees, 24 hand raises, so that's over 50%. So that's a pretty good indicator. More have voted early already in Texas in the presidential election, in the election, than the state's entire 2016 turnout. So we have a flood of people going to the polls. I think it's a very strong and positive sign for American democracy. Here was my visit, a very cold morning. Does everybody remember, if you were in Houston, the really cold morning a couple mornings ago? It was really raw and windy and gray and wet. And somehow I picked that time to go up to the mezzanine level of Rice Stadium. And it was actually not a bad time to go from a being crowded standpoint. And there are poll workers there, and more poll workers than voters. And I just want to say that these people are heroes. These people are heroes. The wind was howling through there, and they were bundled up. It looked more like Buffalo, New York voting station than it did a Houston, Texas voting station. So I can't say enough about these true heroes of democracy that we have. People who are giving their time and I think volunteering to man and woman these polls. And the results, as we see in Texas, are phenomenal. We should not take this for granted here in Texas. You're going to meet Egan later today. Egan's in Missouri, and they do not have early voting, in-person voting. They have mail-in voting, but they do not have early in-person voting in the state of Missouri. So we don't always do everything perfectly in Texas, but wow, what a fantastic thing that we have all been able to go and vote early, and people are doing it. Here we are in the current state of pandemic COVID-19 cases. As most people know, we are now seeing a spike coming out of September when we hit a trough, and we are now moving up again and having a very large outbreak of cases. The good news is we're seeing lower mortality. This goes all the way back to March, and look at this huge spike in mortality early in the virus, and so we're learning to live with this virus and learning how to treat it, and we are getting better at therapies, and so that is the good news. But we are seeing a steep rise right now. These are your answers to our poll, and we asked, will the world deal successfully with this virus? And 61% of you, of the responses, said we will deal successfully with the virus, whatever successful means. Presumably that means a vaccine and therapies. We might. Almost 30% of you believe we might deal successfully with it. Again, whatever successful means. I didn't define that in my question. Maybe I should have, but I wanted to leave it kind of open-ended. And almost 10% of you believe we're not going to deal successfully with this virus, which presumably means we're not going to get a vaccine. So we will see. And I thought it was very interesting that our guests, especially Dr. Lee, said it's uncertain right now. We have a difficult time making predictions. So that 10% of you said we won't. There is some credibility from our scientists who just spoke to us that maybe we won't. We've got not estimates. We've got reports now of gross domestic product for the third quarter, and look at the dramatic turnaround from the enormous fall off that we saw in the first quarter, and then in the second quarter. Look at that, down 30% in quarter over quarter gross domestic product, and a bounce back in gross domestic product in the third quarter, 33%. And it's no mystery that the stock market looks basically like this over the course of the year. I'll show you that slide in a second. Current recession, and we have certainly been in a recession with the enormous drop off in GDP. What does that look like here in 2020? Well, it's certainly one of the top 3 largest recessions that we've seen in United States history, even much bigger than the financial crisis back in 2008, 2009. Not nearly as big as the Great Depression. And of course, as I've talked about before, the actions of the Federal Reserve back in March, and also the actions of the United States Congress, have been very important in making sure that we don't have a repeat of this, down 26% in real GDP. This was a very big depression. Look at that, post-World War II demobilization, a large 12.7% down in GDP, resulting from demobilizing in World War II. Even a little bit bigger in terms of loss of economic activity than this one. Although I think we will say that that was certainly worth it to demobilize from that war. So here back to and I've interspersed the polling questions throughout my presentation today. If running at full capacity, efficiency, and humanity. And I added that third word, right? We like to hear about capacity and efficiency, but I think we're learning this year that an economy means, after all, it's derived from the Greek word for household. Can you have an economy running at full capacity in a household? Can you have a household running at full capacity if we don't have full humanity, right? Can we have a household that is wholesome and fulfilled if there are members of that household that are not being cared for and are not acting and behaving at their full capacity? I think the answer is no. And so, very interesting. Look at the answers split between all these different rates of growth. We've got the largest slice at 28.9%. 3%. That's if the U.S. economy is humming at full capacity, efficiency, and humanity. 3% is the growth rate. Next, 26.3% of you believe in a 4%. Think we could see growth rates higher than 3%, 4%. And then next, a 2% growth rate, 21.1%, which is sort of traditionally what we've been seeing in recent years. Next is a 5% growth rate. So 15, almost 16% of you believe that we could see a 5% growth rate given an economy running at full tilt. And then a 1% growth rate is the slowest of the growth rates, is the least popular of the answers. So there seems to be some belief that our economy can grow at a substantially higher rate than it currently is, given full capacity, efficiency, and humanity. Here's the S&P 500, and I like to show this slide, of course, to show everybody that every single year we see at some point a downturn in the S&P 500, or call it the stock market. Right? I like to remind everybody about this, that there's no such thing as just an only up year in the U.S. stock market. We've had a 0 right here, right? Here's 0, and we've had a -1 and a -2, but usually we see some sort of average fall at some point during the year of the stock market of about 10%. This year, as everybody knows, back in March of this year, we saw a 34% downturn. And where we stand, this is at the end of September. These are JP Morgan slides, and since we're not quite done with October, we don't have these slides updated. We've got a 4% so far up year in the S&P 500. Obviously, the broader market and the global market is different. We'll look at some of those numbers. Year-to-date returns by sector. Look at this. All the way from very positive returns for online retail. It's been a big year for online retail as everybody is stuck at home and not going to the store very much, although look at home improvement. Home improvement stores, as everybody's stuck at home and looking at all the things they have to fix, everybody is also headed out to Home Depot and Lowe's, and those stocks have actually done very well this year in reaction to our circumstances. And of course, information technology, 29%. As people are doing what we're doing right now, staring at our computer screens and upgrading our notebooks and buying, audio things and software. Groceries have very good year for groceries. If people have gone to the grocery store and stocked up and loaded up their pantries and their refrigerators. You may think the entire real estate sector has been a big bust this year, but look at industrial REITs, up 14%, as industrial operations and warehousing. In part, these are sort of associated with each other. Online retail and industrial REITs, right, are related, as online retail requires warehousing rather than storefront space. Restaurants actually up 8% for the year. So we may think that the entire restaurant business has been a complete disaster this year, but it hasn't. The restaurant sector, at least through the end of September, is up 8%. As people continue to visit restaurants, albeit on a more limited basis. Here's the index itself, S&P 500. Materials up 5%. Healthcare, you might think that this has been a huge, huge year for healthcare and all the healthcare stocks. Not so. Up about 5%, roughly in line with the index itself. Consumer staples, and then we start to move into negative territory. Capital markets, industrials down 4%, utilities down 6% as we see a fall off in demand. Residential real estate investment trusts down 28%, apartments down, office buildings, as we know, down, banks, retail, hotels, resorts and cruise lines, as the travel business has been crushed, airlines, more travel, and look at the energy business as demand has fallen off, and as we saw back in February of this year, a glut of oil supply being put on the market by global producers, down almost 48%, which of course has an enormous impact on our city. There are continue to be layoffs announced by oil companies. And I think the thing I saw, the news item I saw today was Exxon, additional layoffs of 1,900 people here in Houston. So the energy business and our city have been enormously affected. And that affects everybody. Had a conversation yesterday about how the hospitals in Houston are being affected by the fall off in the energy business, because who are the customers for hospitals and for elective procedures? Generally people who are more well-to-do with good paying jobs, and those procedures are not being done. And they're not being done also as people lose their jobs in that sector. U.S. growth stocks, I asked, which have done very, very well, incredibly well this year. That section of the market, are they overvalued or undervalued? And 50% of you said they're overvalued. 41% of you said they're rightly valued, and a small percentage of you thought that U.S. growth stocks are undervalued. Let's look at some charts on this. The largest, what does this say here? I've got my little widgets in the middle of the thing. The largest 1% of S&P 500 companies account for 22% of the market cap now of the S&P 500. So this is the market cap of the 5 largest companies as a share of the S&P 500. And look, we have reached an all-time high in that number. The 5 largest companies now account for 22% of the entire S&P 500, far surpassing the previous peak at 18% back in 2000, and even back in 1980 and 1985. The average is 14%. So it's a bit of a cautionary thing, although we know that many of those companies, in fact, last night, we had some earnings reports from Amazon and from Google and from Apple and from Facebook, and all reported very, very strong earnings. So there is some substance to these large market caps. This is just I'm going to show you several slides in a way of looking at this. The top 75 growth stocks, relative trailing price to earnings ratios, 1952 through July of 2020. And look, here we are at this very large peak. Look at this. Look what 2020 and this pandemic has done to these valuations of companies that are growth stocks. Shot them through the roof and exceeded all prior going back to 1952, all prior numbers. The closest we've come was around 2000 in the tech stock bubble. At that time, 4.5 times trailing price to earnings ratios. We are now at a record high, 5 times trailing earnings. So very expensive to a professional advisor like me looking at valuations, but they continue to put up big numbers on their profits. Outperformance may not last forever. This is annualized return in excess of the market for the top 10 stocks. So over time, over the past, what has been the excess return of the top 10 stocks valued in the market? And you see, if you have 3 years before the current time, wow, they've done great, 24% in excess of the market. And then over the 5-year period before the current time, 19.3. And over a 10-year period, they did great. But look what happens after the current time period as we go forward in time for the top 10 stocks. Suddenly, the returns start to fall and 10 years out from the current time. So I want everybody to be aware of that the history of the top 10 stocks may not last forever. So if you're tempted to just jump on the top 10 stocks, look out. You may be disappointed. You may not be. We don't know what the future holds, but this is what the numbers say. Anytime valuations get really expensive, you may be disappointed in the future. Unprecedented spread in returns between small companies, right, and small companies and large growth companies. So small value companies versus large cap growth companies. This is an unprecedented spread where small value companies have underperformed by 25%, underperformed large growth companies. We have never seen this type of outperformance by large growth companies versus small value companies. And I will tell you that over the month of October so far, that has reversed. Small value companies have put up numbers of about 5% returns, where large growth companies are about minus 2%. So at least for the month of October, we've seen a reversal in this trend. Small value companies putting up strong numbers this month. Just another way of looking at this. Look, here's the price to book ratio. So the price to book ratio is the price of companies in comparison, the market price of companies in comparison to their accounting book values. And you see that on the bottom line here, you've seen a pretty steady number for small value companies, which over time we would expect to have the highest expected returns, and large growth companies right here. And again, we're just looking at the same data from different perspectives. Back in 2000 in the internet bubble, look at the price to book ratio for large value companies, 9 times. The value of large growth companies back then was 9 times, and we have now surpassed it. Almost 10 times book value. 10 times the book value of companies is what large growth companies are trading at versus small value companies, which are trading right now at about half of their book value. So we want to be very careful in looking at valuations. Here is another way to look at it. Here is all the times that value companies, going back to 1929, value companies have outperformed growth companies. So everything from the crossover point right here to the right, those are all years. Those are rolling 3-year periods. So these are all rolling 3-year periods where value companies have outperformed growth companies. So you can see that the majority, by about 2/3 of the time, value companies have outperformed growth companies. These pieces to the left, this section to the left of the crossover, are periods, rolling 3-year return periods, where growth has outperformed value. And look, what we're seeing here on this current observation, the current rolling 3-year period, is the period where it's been unprecedented, where value companies have underperformed growth companies. But if you see and you take the full spread of time here, you see that that is a more abnormal observation in comparison to most of them. And that is what the virus has done. This is what the virus has wrought, is a flocking to growth companies that tend to be in technology and online retail. Those companies have really benefited from this period of the pandemic. This is a comparison of the NASDAQ stock market versus the Topix stock market. The Topix stock market is larger Japanese companies. And this is a comparison of enterprise value to sales. So we'll call this value to sales or company value to sales. So we were just looking at price to book and we looked at price to earnings. This is a look at price to sales between US, we'll call it higher growth NASDAQ type companies and larger Japanese companies. And look at the distribution of companies and their multiples of sales. So look at the multiple of sales that the largest plurality of NASDAQ companies are trading at, over 9 times sales. So the question I would ask you is, if somebody came to you and said they'd like to buy your private company for 9 times its sales, what would you say? You'd probably say, show me the money. Here, take it, right? And conversely, if you were going to be paying 9 times sales for a company, you would really have to have a belief that the growth of that company was going to be through the roof on a continuing basis. In comparison, look, large Japanese companies are the largest slice of them are trading at under 1 times their sales. And some of you may have seen that Berkshire Hathaway, Warren Buffett's company, made a $6 billion purchase in the stocks of Japanese companies. I think this is what they're looking at. They're looking at what they see as relatively cheap assets compared to these higher growth stocks. This is a very busy slide, so let me, this is year to date right here. Right, so this box right here are year-to-date returns, and this is as of the end of September. So we don't have October numbers, and you can see growth companies, whether they're large or medium-sized or small, have all put up positive numbers. Although the biggest gains have come in larger growth companies. The pandemic has driven business toward those companies that are growing rapidly and have scale. So even though smaller growth companies are positive, not nearly the effect of large growth companies. And look at value companies, all year to date, negative values. Now the picture since the market low in March of 2020, right, is different. We see very substantial positive values and positive returns that have been put up in all sectors of the stock market, right? So even value companies have done 40 and 50%. Whether they're small, medium, or large size, since the market low in March. Although, as we can see, growth companies have larger returns since that time period, and blend companies do as well. And in terms of valuations, we look right here, over here in the top right, and we can see that even all sectors are trading at a PE ratio that is above the 20-year average PE. So if I just look at large cap value companies, they're trading at about 17 times earnings at the end of September versus a historical average of 13.7 times earnings. So that means that stocks now that they have recovered from March lows, not that cheap. But look at the multiples that growth companies are selling at. Small growth companies, 124 times earnings. Historical value is itself very high, 64 times, but that's double that. And we're seeing almost double the figures for large cap growth and medium-sized growth companies. And you can see all that right here, that we're trading at 126, 136, 187% of the 20-year average price to earnings ratios of these different segments of the market. So the market right now, not cheap. This is a comparison of, and I've shown you this slide before, also from JP Morgan. The gray is United States S&P 500 and its performance dating back to 1997, peaks and troughs. So this is a 106% rise in the market from a peak, from a trough to a peak, and then a 49% drop from a peak to a trough, and then a 101% rise from a trough to a peak, a 57% drop. This was the financial crisis. And then look at the long bull market that we have experienced since 2008, all the way up to here. And then look at this, whomp. This is March of this year, down 34%. But look what happened right after. right? This is what I wrote in my introduction to your program. We have seen in 2020 the steepest drop in time that the market's ever seen, including going back to 1929, and the steepest recovery. Look at that. Look at that. Really, really incredible, isn't that? A 50% gain from the trough back in March. And that, as you think back to the slide I showed earlier, this dramatic drop-off in GDP and this dramatic recovery in GDP looks a lot like this, right? So those who say, well, there's no relationship whatsoever between the stock market and the economy, I would say not so fast, Buster. We clearly are seeing some similarities in the way that the stock market has behaved here in 2020 and the way the economy itself has behaved. Now, the purple graph is international, not including the United States. And what we can see is that international has still not really recovered coming out of the financial crisis the way that the United States did. But as a result, look at the valuations. The US forward price to earnings ratio, that is price to earnings ratio looking at earnings that we expect in the future, 21.5 times earnings on the S&P 500. But look, 16.4 times earnings on international companies that exclude the United States. So international continues to be less expensive than the United States. I know I sound like a broken record. We continue to diversify you internationally for that reason. You're also getting a bigger dividend yield. So look, the US dividend, because prices have gone up on US stocks, the dividend has accordingly fallen. And the dividend payments that you're getting on your international holdings are not double the United States dividend, but almost double what the United States, 3% right there. So that's the international picture. And then if we look at emerging markets, look at this. Right now, emerging markets are trading at half the price to earnings, the price to book ratio of the S&P 500. And the historical average is closer to 0.7. So emerging market stocks on a price to book basis are not just less than the United States, but they are historically lower and are priced at figures that date back more toward the 90s than back in the 2000s. And then same thing in developed markets. This is in Europe and Japan and other developed parts of the world. Historically, the average has been 0.9 times the S&P 500 on its, this is on a price to earnings basis, not price to book, but price to earnings. And then right now we're trading at 0.8 times the price to earnings ratio. So similar to the previous chart that I showed you. Where do you all expect stocks to be a year from now? 51.3% of you expect stocks to be higher. 28.2% of you expect stocks to be the same a year from now. So we'll say at our next conference, which I expect all of you to be at in 2021. And 20.5% of you, 1 in 5 of you, think stocks are going to be lower a year from now than where they are now. Let's take a look at fixed income in terms of term structure. Many of you may notice that I have been making moves in portfolios to bring in the duration on bonds. I'll show you why in a chart in just a second. I'm favoring high liquidity right now, so that things like treasury bonds in places in the market where we can get our money if we want it. High credit. I don't have much interest in lower credit right now because I don't want to reach for yield and get burned on any sort of default. I'm interested in protection, so I'm interested in protecting your money from higher inflation. I'm also interested in protecting your money from higher interest rates, and so I am favoring inflation protection and interest rate protection in bonds. And what can I tell you about yield? In order to get really high returns on high yields, high coupon payments, you have to take a lot of risk right now. And that's something that I'm simply not willing to do in the current environment. And why? Let's take a look at the yield curve. This is the yield curve back in 2013, and this is the yield curve at the end of September. So this is the US Treasury yield curve, and these are shorter term bonds, 3 months, right? whoop, I'm sorry, 3 months and 2 years and 1 year and 3 years and so on. And 10 years is right here. So here's the 10-year bond, and the 20-year is here, and the 30-year is here. And look what we could get paid back in 2013. So back in 2013, you could get a 3% interest rate on a 10-year Treasury bond, and you could get an almost 4% on a 10-year Treasury bond. And you got paid very, very little on the short end of the curve, right? Maybe almost 1% for a 1-year bond. And the whole curve has moved down. Look how it has moved down. And now, at the end of September, you would get paid 1.23% on a 20-year bond, right? That 1.23% on a 20-year Treasury bond is less than you were getting paid at 5 years back in 2013. And a 30-year Treasury bond would pay right now about 1.5%, less than you were getting paid on a 5-year Treasury bond back in 2013. So what have I done? What am I doing? I'm refusing to purchase securities in this area for you because I don't want to take a chance that we buy these bonds and interest rates go up to here again, or here or anywhere higher, and we take a big loss on the value of the bonds. So I'm not willing to say, all right, we're only getting 0.5% here. I'm going to go ahead and get you an additional 50 basis points or 75 basis points, but risk that we could lose 10% in the bond portfolio. And this is why. So if there are any questions about this yield curve, very important slide. I want everybody to understand why you're just not getting paid much on your money right now, but why I don't want to take a bunch of risk to get you much higher returns in the form of yield. Where do you all expect short-term rates to be 1 year from now? Well, 52% of you think short-term rates will be higher a year from now. 42% of you think they'll be the same. And a small percentage of you think that the rates will be lower. So very few of you think we're going to see lower rates a year from now, meaning a lot of you think we've seen a bottom in rates. By the way, if you haven't refinanced your house and you think you could or should, let us know. We have lots of ways that we can help you analyze that, including help on the mortgage banking side. So just putting that out there. If you think you have an opportunity to refinance at more favorable rates and you think you need help on it, let us know. We're doing quite a bit of that for clients. Where do we expect long-term rates, the longer end of the curve that I just showed you, to be 1 year from now? Pretty much looks the same. 52% of you think that we'll see higher long-term rates. 38% of you think they'll be the same, and a small percentage of you think that we'll see lower long-term rates a year from now. Where do you expect inflation to be 1 year from now? 42% of you think, the largest number of you, half of you think, percent of you think that inflation will be the same, which is to say low, and but 42.5% of you, a fairly large contingent, think that we're going to see higher inflation a year from now, and a small percentage of you think we're going to see the same inflation. So 90% or so, over 90%, think we're going to see the same or higher inflation 1 year out from now. I want to talk a little bit about how are we doing on time. Are we good? Okay, I think we're good. Funds and fees. Some of the things I'm doing, I am significantly reducing the cost of your funds, especially in the fixed income area. So you may see that I'm using inflation protected bonds. The cost of that fund is 6 basis points. An aggregate bond fund, I've got that reduced down to now 4 basis points. This is a Vanguard high yield municipal bond fund, 9 basis points. This is a stock fund that I've begun to use, put out by BlackRock iShares, 3 basis points. This is an international stock fund, again, put out by BlackRock, 7 basis points. So one of the things that I'm very focused on is reducing the cost of your funds right now. And so these are, in some cases, at least take STIP or AGG or VWALX, replacing some funds that were charging 50 basis points or 40 basis points. So I am focused on bringing, so we're seeing reduction in the cost of your funds by 75 basis points or so. So I just wanted to bring that to everybody's attention. One of the things that we're trying to do to bring value in a period when yields are very, very low. Dimensional itself is coming out with a new set of exchange traded funds. They will be debuting this month, and they themselves have lower expense fees on them. 12 basis points for the US fund, 18 basis points for the international fund, 35 for the emerging fund. And all these funds include small companies as well, which are more costly to trade. So very, very good news for you on the cost of funds front, and we'll continue to work on that front to bring your cost of funds down. Some initiatives. Let me get a show of hands of anybody who would be interested in Bitcoin. I'm looking at Bitcoin, and the reason I'm looking at it is because it has potentially some positive attributes as a store of value, and Fidelity is doing a lot of work in Bitcoin. They have a new fund that they are offering that I think from an expense standpoint looks pretty good. So Catherine, maybe you can tell me, do we have any hands that are, one hand that's gone up Bitcoin, nobody else interested in Bitcoin? What about curious about it? Maybe you don't want to buy it, but you're curious about it. Do we get any more hands on that?
Yeah, 14 hands.
14 hands go up. So 14 to 17, there's an interest. That just tells me that you'd like to hear more about it. So that's good for me to know. I am exploring a Swiss custody option. I've had a number of clients who come to me and said, you know, I don't know that I want all my money in the United States given the political strife that is going on. So I'd like a show of hands if you would have any interest in custody in Switzerland. We would hold the same things. You would have access to your money. All it means is that you would be able to store whatever amount of your wealth that you would want. We hold the same funds, but it would be in custody in Switzerland. If you have an interest in that, either leave your hand up or raise your hand. We've got about 11 people on the call who would be interested in that. Nope. How many? 16. So there is interest in what is called jurisdictional diversification. So I am pursuing that with a large Swiss bank, and I'll have more on that later. But I wanted to get a show of hands if that would be of interest, and it is of interest, and I understand why people are a little bit nervous about the political situation in the United States, and the Swiss have a very, very long history of being excellent custodians of capital. Let's get to politics. I'm running a little bit long here. We're going to take a break for lunch in a second. Who will win the presidential election? 85% of you think Joe Biden is going to win the presidential election. 15% of you think Trump will. This is, I think, at any point in time, the best thing to be looking at. This is 538, Nate Silver's group, and they run Monte Carlo simulations in the same way that we run, you may remember, simulations on your financial plan and give you a collection of different simulations, and we tell you whether there's a 90% chance that your financial plan is good or 80% that you're going to be okay. He's using the exact same technology, Monte Carlo simulations, and so I tend to think this is the best thing to look at to tune out the noise and get a good simulation of what everything together in aggregate looks like. And Silver is showing a simulation that shows an 89% chance that Joe Biden wins the election and about a 10% chance that Trump does. And that's very close to what you all have said here, 85 and 15. So very, very close to the simulation that Nate Silver is running. There is one, if you look in the middle here, one simulation out of all the simulations that he's run where there is no electoral college majority. Neither of these candidates gets a majority in the electoral college, and the House has to decide, but it's a very, very slim possibility according to these simulations. Which party will win the Senate according to you guys? 74.4% of you believe that the Democrats will come away with a majority in the Senate. And then 25% of you believe the Republicans will. What does Nate Silver say about that? About 77 out of 100 is what Nate Silver's simulations show. So very, very close to what our clients see is what the polling and the simulations that Nate Silver is running believe. So it looks, at least at this point, that there's a very strong chance that the Senate will be held by Democrats after the election. If he loses, will Donald Trump contest the election? 82% of you say he will contest the election if he loses, and 17% of you say he will not. What about Joe Biden? If he loses, if Joe Biden loses the election, will he contest the election? 80% of you say no, he will not, and 20% of you almost say that he will contest the election. Which president would be better for the financial markets? 80% of you think Joe Biden would be better for financial markets, and 20% of you believe that Trump would be better for financial markets. We are potentially entering, therefore, if we assume a Biden victory and a Democratic victory in the Senate, we are potentially entering into a period of unprecedented political reform, presidential reform. So what about questions we may face in that area? So for example, what about financial transparency in the presidency? Will Congress enact into law the requirement that a presidential candidate divulge their finances, that they can't possibly hide them and run for president? What about taxes and conflicts of interest? Will we see reform in that area? What about emoluments, the potential that a president would receive financial compensation that is a conflict of interest while they are in office? Will Congress slam the door on that possibility? What about the power of the pardon and the power of the president to use pardon power? Will there be restrictions that will come about that in political reforms? What about emergency powers, the Insurrection Act, tariffs, which have been invoked in the past 4 years and placed on imports using emergency powers, or military use under emergency powers? So will we see wholesale reform there? What about the criminality in the Oval Office and the belief in the Justice Department that you cannot indict a sitting president? Will we see any sort of clarification of those views? What about the mental health of the president? There is discussion about that and having to test for candidates or anybody entering the Oval Office. So there's a whole rash of presidential of reforms in the Oval Office and for the presidency that we may see. In the executive itself, lots of discussion about the Justice Department and how independent the Justice Department should be and insulated from the presidency, as we've seen closer relationship, to put it mildly, between the Justice Department and the Oval Office. What about acting secretaries? Can a president just not confirm cabinet members and put in somebody who's an acting secretary and say, that's it, this is my guy, and I don't have to go to the Senate to get confirmation? What about inspectors general, which the inspector general laws that were passed back in the 1970s and have been well, let's just say, have been jostled at the very least during the past 4 years. What about whistleblower laws? Will those be strengthened? So an enormous amount of political reform we could see in the executive branch. What about in the legislative branch? The big question there being the filibuster. And we asked you a question about that. What about judicial branch and, for example, term limits on federal judges? A change in the size of the Supreme Court. All these things we could see reform in these areas. Constitutional reform. There's been a discussion about the 25th Amendment and what it would take to remove a president. And does that need to be more clarified? The Democrats put forward a bill last month in this area relating to the 25th Amendment. And what about the Electoral College itself? Something that that continues to be troublesome in this country, as in several elections over the last years, the person who has lost the popular vote has taken office. And this can only go on for so long before a modern country like this and its population says, enough of that. That's not how we expect an election to operate. Electoral reform, as I just talked about. And what about postal reform? We now see debate about, is the Postal Service a business, or is it a service to the people of the United States that functions like the military? And it has to be robust, it has to be immune from being tampered with, and people have to have the ability to receive their mail in a reliable and trustworthy way. So I would expect that we're going to see some reform in the Postal Service. So what do you all think about reform? This is some poll questions I sent out. If elected, should Democrats and will Democrats kill the Senate filibuster? The largest slice of you said that the filibuster should be killed, and it will be killed. So that's the largest That's the plurality of it's the largest slice of the vote here. Next, at 26.5%, they should not kill the filibuster, and they will not kill the filibuster. Next is 23.5% of you said that they should, but they won't. And then the smallest selection, but still a very sizable vote, 17.6% of the vote said they should not, but they will. Very interesting responses. If elected, will Democrats expand the Supreme Court? Should they and will they? 35.1% of you, the largest slice, said they should do it, but they won't do it. 29.7% of you is the next largest, said that they should not do it and they won't do it. And 21.6% of you said that they should do it and they will do it. 13.5% of you said that they should not do it, but they will do it. So the majority of you believe that they will not, that there will not be an expansion of the number of seats on the Supreme Court. What about the Electoral College? Wow, look at this. 58.5% of you said that the Electoral College should be eliminated or modified. There are proposals to modify it where it doesn't have to be eliminated, but that there would be proportional representation in counting of Electoral College votes. 58.5% of you said it should be eliminated or modified, but that it won't be. Next, an equal vote between 17.1% of you said that it should be eliminated and or modified, and it will be. And 17.1% of you, 70% of you said that it should not be eliminated, and it won't be eliminated or modified. And the smallest selection here, 7.3% of you said that it should not be eliminated or modified, but it will be. So what does that mean? That means that most of you believe that it will not be eliminated or modified, let's say in the near future under a Democratic majority. In legislation, I expect under the current voting simulations that I showed earlier that we're going to see a very, very large and active legislature with infrastructure funding, healthcare reforms in immigration, in tax, environment. Of course, we face the challenge of climate change and in trade as well. I think we will see very active legislation in all of these areas. So let's see what you all think. The right size for a U.S. infrastructure plan is 41% of you say $1 trillion. That's the largest of the selections. Next, 29.4% of you say $2 trillion is the right size. Next, 23.5% of you say it ought to be more than that, more than $2 trillion. And 500 billion is the selection by the smallest selection there. The most recent thing I've seen came from the investment bank Jefferies. Jefferies thinks we may see a $3.5 trillion infrastructure plan that emerges from a Democratic-led government. $3.5 trillion, which would be here more than the $1 or $2 trillion. And I tend to agree with that. I think we're going to see a very big infrastructure bill become law, and that I think we're going to see that have enormous and salutary effects in many sections of the economy. What about the world of crises? And I'll be wrapping up in just a second so everybody can take a break and get some lunch. The world might deal successfully with climate change, 73.2% of you. 12.5% of you roughly say we will not deal successfully with the climate change challenge, and 14.6% of you say that we will. So it's iffy. What about in the area of social justice, police reform, anti-poverty, education, childcare, and access to capital, which we can also expect to see quite a bit of change in this area? Will the world deal successfully with social injustice? 61% of you said we might. 26.8% of you say we will not deal successfully with issues around social injustice. 12.2% of you say that we will. I am bullish on the future. So whatever, and this is my final slide, whatever our challenges are, I am very bullish. I think we're headed into a very, very dynamic time for each of us as individuals, for us as a country, and for the world. I think it's a very, very exciting time as Election Day approaches, and I couldn't be more humbled and more gratified to be able to work with each of you as an advisor as we go through these changes. And I also want to say that we're doing a lot of work with you on an individual basis right now. People are going through individual changes in terms of where they want to live and how they want to live. And it is a thrill for me to be able to sit down and talk with you about how we can make that happen for you. So I'm going to turn it back to Catherine right now to get us on track since we're running behind time. Thank you all for your time and attention today.
Sure, absolutely. Thank you, Leonard. And now we're going to have a few minutes for Q&A, and then we'll try to do a quick lunch break. So I'm going to ask the first question that's come in. If you have any questions for Leonard, please go ahead and submit them now. So far, this is the question we have. Does it cost more to move to a different jurisdiction?
Different jurisdiction. Does it cost more? Well, it depends on the jurisdiction. If you're moving to Arkansas from Texas, I would say probably it's going to cost less. We actually have a couple clients who are interested in Arkansas, a very beautiful place. I'm interested in Arkansas, by the way. It's a very beautiful place, and it has a lower cost of living. So I don't quite know the context. If you're asking about the Swiss custody, and I'm suspecting that's maybe what the question is, it is possible that there will be some cost that a Swiss custodian will assess. And I'm talking with them about that. It could be that they're going to, we're used to kind of free custody at Fidelity and American custodians. The Swiss do it differently. They have kind of a base charge. And so if that is the question, then the answer is yes, they will have their charge. My job is to negotiate that as low as possible. And I'm working on that.
Okay, no other questions have come in
Fabulous,
yet.
Great.
Let's see, here's a question that came in through chat. What will happen to inflation with large stimulus packages?
We don't know. We don't know the answer to that. Inflation is counterbalanced by activity in the economy. And so over the last week, the news has been a slowdown in the economy, and clearly the pandemic has been slowing economic activity. So we don't know exactly, and inflation can come from all kinds of different places. You can get supply side inflation where we just don't have access to enough stuff. That worries me. We could have demand side inflation where there's so much demand that it overwhelms supply. And so the theory of inflation coming from large amounts of monetary stimulus is that there are huge amounts of dollars awash in our society, and people therefore are incredibly willing to throw money at whatever it is that they need at whatever price. That's counterbalanced by the employment situation. So if we have high unemployment, which we do right now, then people may not be willing to spend, and people may be nervous about it and may hoard those dollars that are flowing into the economy. So there is no mechanical response that I can give you. What I can tell you is it concerns me, and I'm taking steps in portfolios so that if that does develop, that we've got some ability to fight it off. I hope we don't get high inflation, but if we do, I want to make sure that we've got something that can help.
That's it for those presentations, and we will be back with you shortly. Thank you.